Hello investors, welcome to Simpli Stocks. In our Q4 FY26 results series so far, I have covered 8 small cap businesses from sectors like financials, solar, prop tech, FMCG, etc. that delivered strong results. But today I will talk about 4 big businesses. Now before you hear the word large cap and decide to end this video right here, just give me 1 more minute, because the 4 businesses we will study today, even though they are large in size, they are still growing very fast, or the potential in them is not less than any small cap. And you should also think like this, that in the end, what matters is the return profile of any business. And in fact, the benefit in large caps is that many times their re-rating also happens quickly. In comparison, it takes months sometime in small caps, and small companies do not even come on anyone's radar easily. So that is why keeping large caps in portfolio is equally good. So without any delay, let's get started quickly. The first business that we will study is ICICI Prudential Asset Management Company. If I explain their business to you in very short and simple language, so ICICI Prudential AMC or ICICI AMC runs mutual funds. And apart from mutual funds, they also provide services like PMS, AIS and SIS. But the main revenue drivers are mutual funds and ETFs. Now, what is so special about ICICI AMC that we are discussing it today? Before understanding that, let us look at the industry figures once. Then your interest in this business will increase even more. So you will see in this screenshot that at the end of the March quarter, the mutual fund industry's quarterly average AUM has grown by 21% over the last year, in which equity schemes also saw a growth of 21%. Closing AUM grew by 12%, but generally quarterly average is a better metric to track. Now, firstly, the interesting thing here is that this is a new India that is buying the dip, because in earlier corrections, people used to run away from the markets and halt their SIPs. But after seeing so many sharp V-shaped recoveries like COVID recently, people are instead running to buy the dip. So the interpretation of this for us is that the element of cyclicality in AMC and wealth management businesses has reduced to a great extent. Similarly, you will see unique investors have increased by 13.2% from the last year to cross 6 crore mark, and a fabulous 23.8% growth was seen in SIP inflows. I will emphasize again that these numbers are very special, because earlier new investors would usually come during bull runs due to FOMO. But now we are seeing enthusiasm in investors right from the market bottom. So now let us come straight to ICICI AMC, and you will see what interesting is happening here is that their quarterly average AUM has grown by 25% year on year, whereas I told you that 21% growth came in the sector. So this means that ICICI AMC is growing faster by snatching market share from the competition. ICICI is the second largest player after SBI, and they have a 13.5% share in India's total mutual fund industry. And if I talk only about active mutual funds, in which your ETFs and index funds etc. are not counted, then they command a 13.7% share in the active mutual fund category. As ICICI AMC is so large in size, they have mutual funds in every category. This helps them a lot, because whatever requirement a customer comes up with, they have products across all categories to pitch. So that is another benefit. Now, their customers come from different sources. Mutual fund distributors have a 37% share in equity schemes. Broking apps or inbound leads bring 29% of the customers. These are the people who invest directly in their mutual funds on own. And ICICI Bank, you will see here, brings 8% from cross-selling, and other banks have 11% share. And national distributors account for 15.5% of their customers or investors. Now, let us come to the results. You will see here that their operating revenue has grown by 19.5% year on year. There is a loss in other income due to the market correction, because For an AMC, operating revenue mainly comes from the fees investors pay for mutual funds. In other income are those investments which belong to the AMC itself. For that, they had to take a mark-to-market loss, but that is not a big deal. It is very normal for an AMC, and when the market goes up from here, this same income increases. Then if you come down here, you will see right at the bottom that operating profit has grown by 30% over the last year. We are not looking at net profit. There are some adjustments regarding ESOPs and fees in the short term. They will normalize going forward. ICICI AMC has acquired the management of 5 funds of ICICI venture funds. So they had to pay a one-time fee for that. You don't have to go too much into detail. I will say the main highlight here is this 19.5% top line and this 30% operating profit growth. And try to understand the opportunity here. Such good growth has come during a bear market. Then as the market starts to recover, SIP inflows will accelerate further. On top of that, AUM growth will be separate. So I will not be surprised if ICICI AMC starts giving 25-30% plus growth in the near future. And this is the very speciality of wealth management or asset management companies, because these are your classic annuity models. Annuity model as in, see, Indian markets on an average have given 10 to 15% CAGR return. Add 5 to 10% growth from SIP inflows to that. This sector can easily grow at 20 to 25% rate for years. Then ICICI AMC is also growing faster than the sector by gaining market share. Therefore, this is a good business that you can look at, and it will remain in focus in the coming bull run. The second business on our list today is Waaree Energies. Although the markets reacted quite negatively to Waaree's results, overall, the results and con call were good. There are some stress points, but I'll discuss them with you. Now, look, I have covered the solar value chain in depth many times on our channel. So I will not go back into the details of Waaree's business model or the pricing of modules and cells again. If you have an interest in solar stocks, I have done a detailed video on Waaree Energies. I will put its link in the description. You can watch it from there. So let us come straight to the results. Here you will see that their sales have increased by a massive 112% year on year, or you can say that they have more than doubled. There is 12% increase on quarter basis. But as you come down, you will be surprised that EBITDA grew by 71% only, which is obviously less than sales. Ideally, it should have grown at a faster rate than sales. And the reason for this is that their EBITDA margin has decreased from both year on year and quarter, both point of views. The EBITDA margin used to be 23%, which has fallen by 445 basis points to 18.6% approx. Net profit growth has been 75%. That too is lower than top line growth. They had initially given an EBITDA guidance of 5,500 to 6,000 crore in sales. And at one point, it seemed that they would comfortably beat it, but the weather turned bad. So they remained within their guided range. And you can see here too that in Q3, EBITDA itself was 1900 crore rupees plus, whereas in Q4, it decreased to less than 1600 crore rupees. But overall, I will say these are still decent results. Now, there are several reasons behind this margin compression. One is that because the price of silver rallied so much, we have seen a margin pressure not just in Waaree but in all solar players. Companies are doing R&D and they are trying to reduce the consumption of silver. That is another thing, but silver has caused margin compression. Now, the main impact on margins is due to the war. About 30% of Waaree sales come from exports, and then they also do sourcing internationally, like they import cells from Ethiopia, make their modules, and then supply them to the US. So because of the war, one hit is on the export revenue, where margins are higher, and then logistics costs also increased separately. So Waaree got squeezed from both ends. That is why you will see that the share of export, which used to be 30% in revenue, has declined to 20 to 21%. Order booking is stable. Here you will see that they have also given data for module and cell production. Module production has doubled over last year. This quarter, they have manufactured 4.2 gigawatt of modules. Cell production, however, has not increased, which is a bit disappointing. If cell production would have increased, margins would have received a big boost, because you would know that margins in solar cells are currently high, and they are shifting from monoPERC to TOPCon, which is why cell production did not go up, because lines are currently halted as a upgradation work on site on cell lines is going on. And in fact, you will see, although it is not written here, that there is a decline of 100 megawatt on a quarter on quarter basis. And management has said on this that cell production will pick up speed from Q2. And this cell production is actually the biggest metric that we have to track closely in Waaree. If this doesn't start going up from Q2, then it will be a big worry. And although solar is a very competitive sector, I will agree, Waaree, I believe, will always have the benefit of scale, or the benefit of being large in size compared to the other players. They have planned a large investment of more than 30,000 crore rupees for different businesses. And in this, they are doing capex of about 10,000 crore rupees alone for BESS, in which they are working on BESS containers, battery packs, and cells. Apart from this, a capex of about 1,000 crore rupees is planned for smart meters, transformers, and green hydrogen as well. They have a cell capacity of 5.4 gigawatt right now, and 10 gigawatt more will be added to this. A new development that has happened is that Waaree has decided to enter in solar glass manufacturing too, because in any module, 23% of the cost and 75% of the weight is of the glass itself. India has imposed anti-dumping duty on Vietnam and China for 5 years. This will protect them from cheap imports from there. Then in the long term, it should help by protecting margins, because it is for sure that margins in solar manufacturing are going to fall eventually. And Waaree has announced a capex of 3,900 crore for this. So many developments are happening in this business, and actually this is how you have to evaluate any solar business. Those companies that are able to earn big money in the short term, and who are able to enter different segments, or who are able to backward integrate, only those players are good. And although I have a slight concern myself now whether Waaree will be able to manage so many projects together, but this is essentially the hypothesis you have to follow. Focus on those companies which have a big operational cell capacity. Now, coming to the future outlook, seeing geopolitical tensions and also accounting for the heavy expenses for these capex plans, their management has guided for 7,000 to 7,000 crore rupees EBITDA for this year, which works out to a growth of 20 to 30% over the last year. And this is also what disappointed Dalal Street, perhaps hinting that a slowdown is coming. It might be, but I will say you have to look at the long-term scope and direction of the business. And if geopolitical tensions decrease, that will be a separate trigger here. Otherwise, when these investments start going live from next year, then we will see EBITDA and possibly bottom line expansion from then. So as of now, the market, I will say, just sees Waaree as a solar manufacturer. Therefore, it is pricing over capacity risk and is currently giving a PE of only 23, 24. But I believe with the time, as revenue contribution from other segments increases, then along with growth there will be also plenty of scope for PE re-rating over here. So that is a good business, or that is a good point of view with which you can approach Waaree. Now, a humble request just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are my biggest motivation, so that I keep bringing such high quality research to you for free. So do like this video, and yes, please subscribe to our channel. Now, coming back to our discussion, the third business which has announced very good set of results in the large cap space, and which I see a lot of potential, is Tata Capital. Several interesting things are playing out here that will keep this business in focus. Now, let us start with the business overview first, and then I will get into the details. So, Tata Capital is an NBFC like Bajaj Finance and Cholamandalam Investment and Finance, and they have a loan book of around 2,77,000 crore rupees. To give you an idea, Bajaj Finance loan book is a double of this. They have a loan book of around 5 lakh crore rupees plus. Now, Tata Capital is growing fast, and I was listening to their con call. Their management is speaking with very, very high conviction and confidence that they will comfortably keep growing at 23 to 25% rate in the near term or near future. And it is not like they are just throwing this figure from thin air. They have several levers through which they can execute and bring growth. And you will see that operating leverage will also add to this. So Tata Capital can easily grow its bottom line at 30% plus rate. Now let us move forward. So here you will see their AUM excluding motor finance has grown by 28% over the last year. And you will also notice that all other metrics like cost to income ratio to net profit, ROA, credit cost, there is improvement in all of them. Net profit in Q4 has grown by 51% over last year. Now, I will give you a little background here that will help you to understand the true potential of Tata Capital. So, Tata Capital was a separate NBFC under which they have their different business segments from housing to business loans. This motor finance that you are seeing used to be a division of Tata Motors, which they took out from there and merged here. So, today in our entire discussion, I will emphasize numbers excluding motor finance because that will give you a better picture of Tata Capital's potential and fundamentals. Because this motor finance book, they received it in legacy. Now, this legacy book of motor finance that existed had many issues. Like you will see here that NPAs themselves were very high. Apart from that, because it was a subsidiary of Tata Motors, they used to give loans only to Tata Motors customers. But now they have brought this segment under them and they have also fixed it a lot. And from here, they will start growing it again. You will see in this screenshot that they have now shifted to a multi-OEM model. And out of total loans, 26% of the business is now being brought by giving loans to customers of other auto companies. Apart from this, they have also started financing used vehicles. Lenders earn better margins by charging higher interest rates here. And what I was telling you that they have fixed the book, you will see here that in the last 1 year, they have scaled down the loan book. Motor finance AUM used to be 33,500 crore rupees approx, which has been brought down to 25,400 crore rupees approx. Now, from here, they will grow it again by keeping diversification, yield, and asset quality in mind. Now, the composition of the total loan book has become something like this. You will see here that the share of home loans and loans against property, or let us put it together like this, the share of mortgage loans is 30%, personal and business loans and also motor finance are 99% each. And here you will see that SME, meaning small businesses, have a 27.4% and corporates have a 14.3% share in the total loan book. On the right side here, you will see it is written that the contribution of retail unsecured is 10.3%. These are the loans without collateral, and here lenders earn more money by charging higher interest rates. And this is the second trigger in Tata Capital. Their management's target is that they will take this unsecured book from 10% to 15%. This will drive both growth and also margin expansion. Now, usually you will see I discuss results first and then we discuss management commentary and the growth plans. But in this case, what is happening in the business, in which direction it is going, it was important to understand that in depth, because from the point of view of results alone, Tata Capital will seem a bit average stock to you because the acquisition of legacy motor finance book is hiding its true potential. But from now on, we should see things improving in the right direction. Anyway, now you must have understood like an expert. So moving forward in the results, you will see that AUM grew by 28% year on year. Guidance used to be for 20 to 25% growth. Asset quality has improved, so your credit cost has also decreased. Here too, management has beaten the guidance. ROA has reached 2.5% in Q4 and ROE has also come to 14.6%. Net profit guidance was 32 to 35%. but here you will see how much they did, 51% growth. So overall, the numbers for Q4 and FY26 both have been good. And for the next 2 years, management has given guidance that they will grow their AUM at 23 to 25% rate and net profit at 30% plus CAGR. Right here, you will see they have a target to take their ROE to 17 to 18%. They will also be improving the cost to income ratio, and the business will get more operating leverage. So all these things are there, we need to track. In this, AI also has a role to play. AI has helped banks and NBFCs a lot. Like if you study Bajaj Finance, they have integrated AI very well into everything from underwriting to calling customers. All tasks and workflows have been automated. So they had cost savings from this. Now Tata Capital is also doing the same. Therefore, this I will say is a very good deal in Tata Capital right now. If you compare with Chola and Bajaj Finance, Tata Capital grow faster than them, but valuation is less than those players, because you will see here that Bajaj Finance trades at a PB ratio of 5.3 and Cholamandalam and Investment and Finance is currently at 4.7 PB. You will see Tata Capital is at a price to book of 3. Therefore, there is scope for re-rating here as well. So that 30% growth add to this whatever 10 to 20% scope for re-rating. So this easily becomes a 40% plus type opportunity for you. Although one overhang in this is that their IPO came recently, so promoter holding is high. They will have to bring this down to below 75% in the near future according to SEBI rules. But I believe that is not a big deal as far as business is moving in the right direction. People will come to buy the stake. Therefore, even though Tata Capital is a big business, do not take it casually. And one more advantage corporate backed NBFCs get or have, like Bajaj Finance or this Tata Capital, because their brand is so strong, their cost of funds remains low, meaning they are able to raise money from the market at a lower rate. So this is also a lever in Tata Capital. So motor finance and retail book expansion, and then re-rating and this cost of funds advantage. These are 3 to 4 triggers that make it a very sweet, interesting business. Now this video has stretched a bit long. So finally, let us quickly look at Eternal or Zomato as our fourth stock. And I also did a separate dedicated video on Eternal recently. In that, I explained everything to you. How now the main trigger in Eternal is Blinkit, their quick commerce business, and not Zomato or the food delivery business. If you have not seen that video, please watch it. Otherwise, Eternal will bounce over your head and you won't even understand their moat. And I will drop its link below as well for you, so you can watch it from there. Now, coming straight to the results, I will mainly discuss food delivery, Hyperpure, and quick commerce businesses. The district business is still in the building phase. Investments are happening in it, and money is being spent on marketing. So it is at a loss at EBITDA level. We will skip it. It is not a big business anyways right now. And now coming to Zomato, you will see 19% growth has come in the food delivery business, which was expected. I had highlighted this in the previous coverage as well, that gas shortage is not going to hurt Zomato a lot. But on the contrary, you will see due to rumors, the stock had corrected so much. The food delivery business from here, it will keep growing in this same 15 to 20% range. Hyperpure or their B2B restaurant supplies business has degrowth because operations of many individual restaurants have been affected. But that is, I will say, short-term problem, and it is not a major risk. And although Hyperpure's revenue declined, quarter on quarter at an EBITDA level, it is still positive. Therefore, there is not any impact on their profitability. Finally, coming to the most important segment, which is Blinkit, you will see here that NOV, meaning how much money their customers are spending on their platform, NOV grew 95% year on year. If you see revenue, there is 674% growth here, but Blinkit has shifted to its own inventory model, which is why it is looking so high. So for us, the better metric to track is the NOV growth. Now, finally, you will see here that there is also slight improvement in margin. as adjusted EBITDA has reached 0.3%. This is the trigger in Blinkit that despite so much competition in the market, Blinkit has reached break-even at the EBITDA level, meaning Eternal doesn't have to run its quick commerce business in losses like Zepto or Swiggy anymore. So that is a big thing. And right here, you will see that number of customers grew 15% quarter on quarter. That is good. The store count has grown 72% from last year, and they now have more than 2,200 stores across the country. The market is slowly maturing because from here, Blinkit has a target to reach 3,000 stores by next year, which comes out to 34% growth. So perhaps we can say that either this business, or actually I will say the whole sector, is touching the ceiling of TAM, or the total addressable market, that perhaps this is the actual size of the market. That market is not bigger than this. Like until now, if I give you some perspective, NOV had been growing at 100% CAGR, but now for the future, they are targeting 60% CAGR growth. Now in this, they will be bringing growth mainly by expanding into non-metro cities, some big non-metro cities, and also adding more categories of other products, or basically what we call assortment expansion. So this is still, I will say, very good guidance. It is not like business has turned bad, because along with the top line growth, the profitability should also improve on such a large base. Now let us finally look at their cash balance. This is important. Here you will see that the cash balance has declined from the last year, but there is an addition of 152 crore quarter on quarter. And although there is contribution of treasury income in this, but overall I will say Eternal has come to a minimum cash burn or stable cash position, which is again a very good thing, because you will see, if you go and see, all their players from Instamart to Zepto, all are burning money heavily. Now, if competition decreases in the sector, that will be a big positive for Eternal. We will see re-rating happening quickly. Otherwise, apart from that, this business is doing well, then obviously we will get to see some re-rating over the long term. Many people will not be comfortable with the valuation in Eternal, but I will say, if you are looking at this business, you have to grasp the long-term scope, because admit this, that quick commerce as a category is definitely going to stay. It is just that competition has to come down. Only then profitability will improve for the players. In the end, I hope you found this video helpful. My only request to you is that you like this video, and yes, also subscribe to our channel. You see that I constantly bring in-depth research videos for you, and also a lot of hard work goes into all of this. If you like my videos, subscribe to the channel and also share my analysis with your friends. I will get much more motivation to work for you. So do support me so that I can bring more such videos for you every week. I will see you in the next video. Happy investing.